Hi everyone.
How's my okay? Can you hear?
Yeah, you got your slides and everything, Amy?
Yeah, I've got my stats already.
Anything happen, I have a copy with me.
Yeah, Elin told me. So better shut down this WhatsApp.
How many RSVP we have for today, Esther?
Sorry?
How many RSVP we have for the session today?
Wait, 138.
Oh,
100 and what?
138.
38. Okay.
Get back. I'm a crime. Share it fairly, but don't take a slice of my pie. Money, so they say, is the root of all evil today. But if you ask for a rise, it's no surprise that they're giving none away, away,
Yes, absolutely. I certainly was in the right.
Hello, good morning, how you doing? Waking up, shaking yesterday's blues, yeah. Turn the TV off, it's bad news, man. Feeling fresh like a Ziploc new man. OJ with a champagne tuna. Mimosa Holy Ghost running through ya. Hell yeah, it's a new hallelujah. Popping like the top off a bottle and I ain't stopping, yeah. Baby, it's a brand new day. Ain't no clouds hanging over me. Something doesn't feel the same. The rest of my life gonna start today. Good morning. Good morning. Good morning. The rest of my life gonna start today. Crawling up the ocean, this is evolution. Can I grow into another animal, the next level? I'm sprouting wings and I just wanna sing. In the future, now the past can't harm me. Forget about yesterday, Paul McCartney. I'm feeling like a Beatle on stage, and the whole wide world's gonna know my name. Baby, it's a brand new day. Ain't no clouds hanging over me. Something doesn't feel the same. The rest of my life gonna start today. Good morning. Good morning. Good morning. The rest of my life gonna start today. Ladies and gentlemen, this part right here is very simple. It goes like this. I've been up, I've been down, but I got the feeling right now. I've been up, I've been down, but I got the feeling right now. I've been up, I've been down, do you got the feeling right now? Baby, it's a brand new day. Ain't no clouds hanging over me. Something doesn't feel the same. The rest of my life gonna start today. Good morning. Good morning. Good morning. The rest of my life gonna start today. The rest of my life gonna start today.
I need a dollar, 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 that's what I need. Hey, hey. Well, I need a dollar, 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 that's what I need. Hey, hey. Said I need a dollar, 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 that's what I need. And if I share with you my story, would you share your dollar with me? smile may take away my sorrow. Maybe it's inside the bottle. Maybe it's inside the bottle. I had some good old buddies, names is whiskey and wine. Hey, hey. And for my good old buddies, I spent my last dime. Hey, hey. Now wine is good to me. You help me pass the time. And my good old buddy whiskey keep me warmer than sunshine. Hey, hey. Your mama may have blessed the child that's got his own. Hey, hey. If God has plans for me, I hope it ain't written in stone. Hey, hey. Because
So I'll be sharing my screen again.
Yes, I mean, after I introduce you, okay?
Yeah.
So good morning, everybody, and welcome, and thank you for
Morning.
being in today, today's session. So for your information, this is session number 2 as part of Ata Plus education series. We did session number 1, I think a couple of weeks back on financial projections. And this time around, this week, we have the co-founder of Ata Plus, Aimi Aizal today, that will talk about the art and science of valuation. So this Ata Plus education series is, is an effort or a campaign to encourage companies to sign up for ECF or B2B alternative funding. And we found out that most of the companies that were part of our alternative funding campaign were not all of them, but some of them are lacking in terms of basic company valuations, due diligence, financials, and so on. So this education series is an effort to try and build the capability and capacity of our companies in order to gain fundraising or have better chance to gain fundraising, right? So without further ado, I would like to invite our speaker for today, Aimi Aizal, the co-founder of Ata Plus, to share with us a little bit, I think for 2 hours or maybe 1.5 hours, and then we can do a Q&A session and a little bit on valuation. So Aimi, the floor is yours.
Thank you very much. Sorry. Thank you very much, Hafiz. Thank you again. This is probably actually my second time on this education series by Ata Plus. Thank you. I see there's about 50 participants this time around. All right. As Hafiz said, this series is meant predominantly mainly to help some of the startups, especially who are doing some fundraising through alternative funding site like Ata Plus. And we do see scenarios whereby some of the participants may have some challenges, especially in certain matters regarding fundraising. And valuation, especially valuation, is actually a depressed, I would say, a depressing or a pressing subject or a depressing subject that being faced by a lot of people. Yeah. How do I? Yep, there you are. Thank you very much. Okay, so valuation is one of the topic which is very pressing, which a lot being asked by investor. And a lot of startups company are kind of stuck when it comes to this particular topic. And although Hafiz mentioned just now, these are some of the basic things that we can learn today or be able to understand a bit more today. The truth is, the valuation is not really as straightforward. It is always a combination of both science and science and art, I would say. Yeah. But I would try my very best today to make it as simple. If failing which, there are probably about 2 or 3 matters, that you just need to remember at the end of this session. So I think without the name, I'll just go through. So today, what I will do is I will cover some of these topics, some of these items I should on the screen. The importance of valuation, which I roughly mentioned earlier, the basic principles of valuation. What are they? And I will cover all these basic principles today, and perhaps also to go through how it applies in valuation, some examples, and take home. Of course, it would also help to those who actually participate in the last session, which is about cash flow projection. So, but today I will not cover that. I assume you already roughly know how to go about doing cash flow projection and forecast, and how best to actually be able to convince people to actually believe the forecast and projection. That was in the last session. But I believe MDEC do have what do you call it, a recording video on this. You may want to be able to access that. And of course, the number 5, as I mentioned earlier, if you did not be able to grasp a lot of things that I am going to go through today, hopefully, there are a few things that you can take home and remember. Yeah. Now, valuation, as I mentioned earlier, let's see. Okay. As I mentioned earlier, typically is a very pressing challenge. It's a pressing question. May not just pressing, but also depressing sometimes. Yeah. Typical question by the investors would be, how do you get your valuation? Sometimes I've seen companies that comes to us, for example, come up with some numbers that the valuation of my company is like 40 million, 30 million, or even some even goes up to as high as 100 million. And simple question I always ask them, 100 million. Do you know that there are quite a number of companies in the public listed company, which is now in the Bursa Malaysia, doesn't even reach 100 million? So, I mean, these are the kind of, and they say, oh, is it? I thought it is 100. Then when I ask them, how do you do that? How do you compare? Oh, because our business is similar to, let's say, for example, eBay or Facebook or Google or something like that, or Grab for that matter. Yeah, but they are currently valued at 300 million US dollar. That's $1 billion, something like that. Yeah. So we are just small. So what is 30 million or 100 million ringgit? Yeah. I mean, this again, pick up from the sky. So again, when the investors start to ask more questions, then they jam. They got jammed or unable to actually proceed. And a lot of time, this is the time where actually where it takes most of the time for negotiation between the investors as well as the startup company, right? So that is a question. And typically, like I said earlier, entrepreneurs would want to have as high valuation as possible, whereby investor, I wouldn't say they want as cheap as possible. They want something which is value for money. And today, what I will do is I just try to cover that. What does it mean by value of money, and how do they look at it, and how do they see you as a company or as a person, that they are going to invest in? All right. Again, I said, typical entrepreneurs based on the expected return, based on customer or data growth. Some will say that, yeah, but I've already got so much, traction. I've got signups like 20,000 or whatever it is. Because of that, 20,000 is some percentage over whatever sign up by Twitter, for example. Then I should be valued, so much. And some again comparable to many companies like I mentioned, and they always bring in companies with big names, yeah. But what they do forget is that actually this is some of it. Most of the time they don't really actually compare apple to apple. What do I mean by apple to apple? Okay, what I mean is that you must look at these companies, not when they are now. If you really want to compare, yeah, you must look at them when they were 5, 10, 15, or even more than 20 years ago. Just like Google, for example. Let's take a few examples that I've actually outlined over here. Google, yeah. Google started in 1996. Actually, sorry, that's not 1998. It started in 1996. They had their first fundraising in 1998, 1999. Yeah. And at that point in time, there are not much traction as far as Google is concerned. Yeah, because there were a lot of other search engines in the world at that time. I'm not so sure whether any of you are aware. There was about approximately 5 years ago. Some of you were probably still in school, but in those days there is this directories, fast services like Yahoo. That is actually a service directory company, Yahoo, which is very famous, multi-billion-dollar, yeah, who are already in the market. Of course, there are the Alta Vista, Excite, Hotbot, and I can't remember anymore others, but there are quite a lot, yeah. And suddenly, this Google guy, Larry Page and Brin, trying to come into the market and say that we are faster than any one of you. So what happened, when they started, they find it very difficult to actually convince their investor to actually raise some money. But there are a few people who actually came in, actually helped them. Most of the article doesn't actually say, how many percent they took up. Maybe it's just perhaps just a loan, but some of the earlier investors or people that actually helped Larry and Brin, Page and Brin, actually, sorry, is Ram Shriram. That's one of the multi-billionaire, and also Jeff Bezos, who is actually the founder of Amazon. They put in about 100 to 200,000, and I was told, if you read through some of the articles, they put through a few more, maybe 10, 20,000, or another up to 100,000 over a period of time when they started this together. This last time. Having said that, if you read through the story of Google, even Larry and Brin, actually, what happened is that they met more than 70 venture capitals before they actually make their first break. In fact, they almost gave up, and they wanted to sell the company at only $1 million US. That was to Excite, but Excite actually negotiated with them and said, no, we cannot buy you at 1 million. We offer you 750,000. So they accepted 70,000, and yet what happens is that the deal did not go through. Today, I think sometime earlier in the mid of 2015, 17, Google was valued at $1 trillion. Yeah, $1 trillion, more than $1 trillion. So you imagine this, yeah. So of course, someone who actually does something like this and say, yeah, Google $1 trillion, then why not me? $10 million. Not much different. I mean, there's only a peanuts compared to Google. But you can't do that. You have to go back to the time. So the same thing goes to Facebook. So there are references I made over there as well. The same thing goes to Facebook. Started 2003. At the time they grew a few thousand from the traction from the university, predominantly most of it. And the valuation was about 5 million. The earlier investor was Peter Thiel, which put in about 5,000 for 10% of the company. Twitter, the same thing. eBay, the same thing. I wouldn't want to go to detail, but you can read through some of the story of them, when they started. Except for Microsoft. The Microsoft is slightly different because they had quite a good cash flow almost from the very beginning. They don't really need the 1 million that they raised, but it was more mainly to get a good venture capital to actually have in part of their portfolio of shareholder, so that they can actually bring to the company the next level. Sometimes, it is important not just about the money, but it's also to have a good investor in your portfolio of shareholder. Yeah. So Microsoft, from the very beginning, they never go into what they call it, Series A, Series B, whatever, mezzanine. They don't. They already had a good cash flow, and you may want to watch this movie called, I can't remember what is it called, Pirates of the Silicon Valley or something like that. It's a good story about how Microsoft started, and also Apple at that point in time. Yeah. Now, what are these 3 basic principles? Number 1, actually, valuation. These are the only thing that it's all about valuation. And number 1 is you are valued, or you are what you own. Okay, simple, right? Yeah, I will go through, but of course, from the perspective of company, what does it mean by you own? So I will go through some examples later. Some of you may have seen how a financial statement look like, audited account looks like. Some of you may not have. If you have not, then you may want to go back later, have a look at some of these things and try to understand, where does that calculation come from. Of course, similarly, then the second one is you are what you can earn in future. Similarly, so again, why do people value company or see company or value based on what they promise? It's not really what they are today, yeah, and what they have in their pocket today. And of course, the third one is what others perceive you are. Okay, this is typically the scenario where you are already quite established. You know, you have traction, you have a brand. It is what others perceive. But the problem is, or the issue now is that many entrepreneurs doesn't go on this principle. The last one, what I'm saying. They don't really go on a scenario where what others perceive you are. They are more into what they perceive other perceive they are. Okay, or it is what they perceive they are. So that's how they come up with 100 million. That is my valuation now. Yeah, and I will not bash in it. And when it comes to trying to justify that, then they get stuck and they find it challenges and they get frustrated. Yeah, so there'll be a lot of questions. There'll be a lot of things that investors will actually ask. Yeah, especially from the institutional investors. Now, the first principle, what you own. This is actually very simple. Yeah, it's just like you have something that you own, and that's basically what you're worth. Yeah, and it's the easiest way to calculate because you can value. You can value all the things that you have, and you can actually and most of the time, if you say that, oh, my company, I value my company based on NTA. Most of the time, investor will not ask you too many questions. They would happy to do that because I will show you later when it comes to the numbers. Why they are happy to do that? Because there's no premium. I buy what I get. I see what I get, and I am paying what actually I see. Yeah. So that is pretty much there. So net worth comprises of. Okay, but for a company, what does it mean by net worth? What do you mean by what you own? It means that the net worth company means the asset less liabilities. So because a company does not just mean it has asset, but it also has liabilities. I will give you some example again later on. Most of the time, it is the lowest valuation. But the problem with this is that what if you do not have asset? Yeah. What if you are a service-based company where you actually provide services? You may have asset, but most of your assets you don't actually own. You rent, yeah, or you lease your machinery. You lease your office, and premises. So basically, what you have is actually just people. So how do you value that? So that is why, most of the time, this can be quite a challenge, if you do that. And most of the time, people don't use NTA or don't use net worth, simply because there's always some elements of what's we call premium to the business. The sweat equity that you put in to build the business, and other things as well. If there's a brand, the brand that you put in, these are all equity value that you can't actually quantify just giving, say that, no, I bought this at this amount and this is the price. No, yeah. Because of that, this valuation is normally used when in a situation where you liquidate the company, meaning that you close down the company. So a liquidator will come to the company. What they do is, they look at all the asset and liability, they strip it off, and say, okay, what I can sell, I sell. What I can pay back, and what at the end, the cash that I get. And they use this cash to go and actually either pay back all the creditors, whatever that they claim out there, and say that, okay, this is your net worth. So that is basically being used. Most of the time, this net worth is being used in a liquidation situation. Now, just to for those who are not familiar, but I'm sure a lot of you are familiar, so I will not go too long on this. Perhaps just go through examples. Assets are divided into two. Yeah, number one is tangible asset, and the other one is intangible assets. What does it mean by tangible asset? Tangible asset is what you can see, what you can quantify, what you can immediately be able to identify. So these are, for example, stocks. You have your stock. People can see, okay, your stock. You bought the stock at 100 ringgit each. There are 10 of them. There's 1,000 worth of stocks that you have. So you can actually cash. Definitely, it's very liquid. You have cash in the bank. You have cash in your under your pillow, whatever. You have cash. Yeah. Investment is also something which is tangible, meaning that I have a record that I actually bought this company, I bought this whatever. Yeah, building, again, motor vehicle, your cars. Again, all these things has to be registered, has to be in the name of the company and recorded as the property of the company. If you have a company, but at the end of the day, the car is actually, under your wife's name or your name, then that is not the property of the company. So tangible asset has to be something that is actually, be able to, is actually registered, under your under the company. Receivable, that is, what does it mean by receivable? Is amount that people owe you. So this is also something which is collectible, something that you can actually recover. Of course, if you understand the principle of accounting, those who are not recovered, normally it is recorded as doubtful debts, or bad debts, which is actually you expense it off. So in typical scenario, receivable is also an asset. Deposit that you paid, for example, your utility deposit, your rental deposit, and so on. These are deposits that you can get back. You can actually recover. Let's say if you no longer use the premises, then you can actually get back your money. So that those are also assets. Now, what about intangible? Very hard to quantify, but the only thing that you can quantify is the first one, goodwill on acquisition, because this is something that is already being realized and it's actually recorded in your books. For example, when you acquire a company, when you calculate the net worth of the company, let's say is 10,000 ringgit, but you bought the company at 15,000 ringgit. So what it means that when you consolidate the company, then all the asset and liability will only appear as 10,000, but because you actually pay additional 5,000, that 5,000 will appear in your account as goodwill on acquisition. So that's the only perhaps intangible, because it's something that is already realized, that both party has already confirmed that, I'm willing to pay you so much. But other than that, what you see down there, brand, trademarks, patents, copyright, knowledge, expertise, these are something is very hard. And and most of the time it's very much judgment call. Brand, how do you calculate brand? How do you actually quantify? How do you value brand? Yeah. So of course, you can do survey, and typically people talk about brand. What's the mind share? Yeah. How many people under mind share means that, let's say out of survey of 100 people, how many actually have heard of you? If only 1% of them, then it's only 1%. Actually, so that your mind share is actually only 1%. But if 70 people actually out of 100 knows you, heard of you before, then your mind share is actually much higher. So that's what mind share is. Trademark is the same thing. Trademark is like your logo, your name. These are trademarks. Patents, another thing. Copyrights. Knowledge and expertise is something that you document, that people perceive, that you actually have. Those are also of value that it's very hard to quantify. And out of all these intangible that I mentioned down here, only patent and trademarks can be legally registered. In Malaysia, you have my IPO that you can actually register your trademarks, but that is not patent. A lot of people come to me and say, "Yeah, we have already registered our they call it our intellectual property. We have all these things, and to them in their minds actually their know-how, their skill, and so on. But in actual fact, what they do actually, they just actually register their trademarks, which is actually the logo, the name, the brand, in that sense. Not really the work that they've done, the documentation, because patents, it's very hard to. It's not. First of all, it's not cheap, and it's not easy as well to register. Copyrights, you can't register copyrights, but basically anything that you write, you just say that this is my copyright. Just like this presentation, for example, this presentation is the copyrights of Atta Plus, for example. So you can actually mention that. But again, the moment there's some changes, some guy just snaps this particular snapshot this and change the entire content by just additional one line, then it's no longer your copyright. So actually the same thing goes for patent and other things. So it's a very tricky subject by itself. Maybe later. I'm not so sure whether MDEC would want to actually go into this to have a series of education just on intellectual property. But I say it's a very complicated, and even not every lawyers are expert in this. There are special lawyers and counsel that actually only look into this. Liabilities, quick one. What are they? Your loan, things that you have to pay. payables, the amount that you have to pay to your supplier, your shareholders, loan stocks, landlords, staff, even your staff. Maybe you owe them, one month, especially currently in the current pandemic. A lot of people, are unable to even pay staff salary. Those are your liability. You don't unable to pay your staff salaries, you owe them. And of course, the authorities, taxes, EPF, as you know, EPF always allow you up to 14 days, 15 days, if I'm not mistaken, to pay. So if you capture it, by the end of the month, then you still owe technically the authorities like EPF and SOCSOs the previous month. Deposits that you take, if there is any, that is actually, if just now deposit that you paid, this is actually deposit you take. Right now, those are liabilities that you can quantify. Okay. The other part of liabilities, which is very, very hard to quantify, it is called contingent liabilities. What is contingent liabilities? These are liabilities that may only occur or may only happen or pass due upon the occurrence of an uncertain future event. You can see that there are two uncertainty there. First, you don't even know whether it happened or not. Number two, it depends on something in the future which you also do not know will happen or not. So that is why it is termed as contingent liabilities. For example, legal suit. Someone actually, sue you and say that, no, I'm going to sue you 100,000, whatever it is, for whatever. Yeah. And it's actually go through the process, the motion of the court proceedings. And that will take time. And you will know whether you win or you will lose. That's number one. Number two, you would also wouldn't know what is the amount. Of course, they claim 100,000. Maybe the court decided 50,000, or maybe the court decided more than that, plus penalty and everything else. So you wouldn't know. The other thing that is uncertain would be product warranty. Yeah. For example, you sell products and you give guarantee of the product or warranty of the product. Again, you wouldn't know. Someone will just, for all you know, the entire product or the entire batch of your stocks, got returned, and you got to pay, and you did not expect this, in your books. So again, these are something which is uncertain, and most of the time in the accounts, if you look in the audited account, it doesn't appear in your statement, but it appears in your notes to the account. So there is always a note to the account that says contingent liabilities. Then it will actually explain, the company has gone to a suit, whatever people sue, and the product warranty, all these things, and they can do some estimation if they want to. It all depends on the accountant and auditors who actually audit your company. How much, they call it, disclosure that you require as far as contingent liability. Of course, there is a standard under the Malaysia accountants that actually say what you need to disclose. Now, net asset versus, so you seen just now, as far as company is concerned, the net worth of company is actually the net asset of the company. So what is net asset? Very simple. It's just mathematics. Yeah, it's actually total asset that you saw earlier. Total asset less intangible asset, if there is any. Yeah, which actually predominant, which is actually the one that the goodwill on acquisition, because other intangible you can't actually quantify that in your accounts. So total tangible asset less intangible, plus intangible asset less total liabilities that you have. That is your net worth of the company. All right, because that is the real net worth of the company. Now, but there's also terms like NTA or net tangible asset. What does it mean? It means that you only quantify, you only calculate the tangible asset of the company, which is actually the total tangible asset of the company. Yeah. So they don't calculate those intangibles. So this is actually NTA. So what about shareholder funds? Have you heard? Or the shareholders' equity in the company? There are many terms that are being used in the market the market now. But I'm just using a shareholders fund. It's typically the net asset of the companies or the net liabilities of the company, because if it is negative, net liabilities of the company, which encompass both tangible as well as the intangible asset, such as the realized goodwill, which I will show example in the next slide. I'm not so sure you can see this. It's quite small, but I guess you would, because you are watching this from your screen. All right. So what does net asset mean? Net asset equals, so net asset technically, as I mentioned in the earlier slide, is roughly is equal to the shareholders fund. So in this case, the example here is What does net asset? The total asset of the company is 45 million, which is this one, 45 million. I'm not so sure again whether you see my cursor or not. It's 45 million that is boxed in red there. It's less total liabilities, which is this one down there, and it's equivalent to 26,504 million. So if you look at 26,504 million, it's also equivalent to your shareholder fund. In this case, it terms as total equity or total deficiency. So if negative deficiency, yeah. So it's the same number. So typically, yeah, the net worth of the company is actually, the net worth of the shareholders, yeah. So the net worth of shareholders is equivalent to the net worth of the company. That's how it's been calculated. So net tangible asset is quite simple. So it's net worth of the company, which is this amount, 26 million, less the goodwill, which is 250,000. So again, it's pure mathematics. So no science about it, not much art, but it's always about negotiation that comes where the art is. Now, what about the second principle? This is probably the most, I would call, relevant principle to a lot of startups. Yeah. Sorry, especially because most startups do not have assets or not much assets that already producing any income today. And most of the time, when you are a startup, you start a company maybe after a year or half a year, you still going through your sweat equity, your own money. So you want to raise some funds. And most of the time, actually based on what you project in the future, how your business going to grow, what you intend to do, your aspiration, your motivation, and all those things. Yeah, and you need to be able to convince investor all this. And perhaps some of you be able to have some traction, but again, it may not be reflected in the numbers yet. But it may and will. You believe you will be able to reflect that in your numbers of earnings in the future. So again, if you miss our earlier session on projection and forecast, you may want to have a look at the video recording, because I actually went through a process of coming up how best you can actually come with the best projection and cash flow that I would say good enough that to be able to convince investors. Yeah. Now, the question is, why do people do it in this way? Why is it based on future earnings? So the question is quite simple. Would you put any money, let's say for example, ringgit machine today, 1,000 ringgit, that you would receive 2,000 ringgit in the future? So of course, if you don't think twice or you don't think deeper, you would immediately say, of course I would. But if they ask me, I say, that depends. If your 2,000 I receive next year, maybe I would take. But if your 2,000, I can only receive after 10 years, 20 years, then I might not even consider it at all. Why? Okay. Because I will show you why. Because future of money future today and today, 1,000, 2,000 ringgit in 10 years time that you receive may only worth perhaps 50 ringgit today. Maybe today for 2,000 ringgit you can buy, I'm not so sure, a decent mobile phone, for example. But for all 10 years on the road, 2,000 you can only buy, I don't know, a roti canai. I'm not so sure. Of course, that is the extreme of it, but yeah, just like how when mobile phone started, it only costs you a few hundred. Maybe actually when it first started, it cost you 20,000. Then it goes down. When it flooded in the market, it goes down as low as 200-300 ringgit. And now, the average, a good one, perhaps 3,000 and above, or even 2,000 and above. Yeah. Now, but the question is, when you come out with all this your future, when you tell your investor your future earnings, your everything else, the big question that the investor will always ask, can I trust you? How much can I trust you? Okay. So it's always the question is, can you trust the person that promised the future or not? Because most of the time, investors never heard of you. Most of the time, or even they have heard of you, they do not know you personally. So how do they know you? They perhaps do some due diligence and find out from other people, how you are, whether can you be trusted or not, for example. The other thing is, trust the data, because when you show your forecast, you show data, right? You show, okay, these are the data, these are the analysis, this is the future that I believe, this is how I believe the economy is going to grow, and all these things. So then question, how much the investor would trust all this data, whether the future data, the prediction, or even the historical data. Yeah. And of course, finally, you formulate all these things and then you come up with your financial projection forecast. So the question is always, how much do you trust your numbers? Again, if you are not, you may want to go through some of the earlier session that I had on financial forecast and projection. So trust is a very, again, very, very important element when you want to pitch your company when it comes to valuation to the investor. Yeah, you can't actually address all these things, then you will find it very hard. Either you will fail in your fundraising exercise. But what's the challenge? I mentioned earlier. What's the challenge when it comes to future money? Number one, the value of money that you earn in the future is never going to be equal to the money that you earn today. Yeah. So 10,000 in 10 years, perhaps it's only 3,000 ringgit now, perhaps. Of course, I will show you the calculation later and you will shock by the numbers that you can see. Yeah. So that is one. Simple principle. Number two, there's no guarantee. Yeah. There's no guarantee also. If I put the money, invest in this company, there's no guarantee that if the investment will even go bust. If the shareholder or the entrepreneur just run off with my money, there's no guarantee. Of course, there's always ways to do that by coming up with a proper shareholder agreement and things like that. But again, if it's done, it's done. They took off my money, the investment money, go to Hawaii, have a good holiday and stay there and migrate there, for example. I don't know why I took Hawaii, but yeah. So anyway, that could have happened. Yeah. And there could also be shareholder tussle. Sometimes what happens, you as an investor, you are just put in, let's say 30%, 20% in the company. Suddenly the 70% start to quarrel, start to gado, have a tussle among themselves. They see good big money comes in from investor, then they get greedy. Then everybody will start to go back to their the agreement which they never signed, perhaps. A lot of things had this happen, believe me. Yeah. And of course, force majeure, something like pandemic. A lot of companies got affected, but at the same time, there are a lot of companies actually, being created also in this, pandemic scenarios. So again, people will know there are companies that actually is very good, that they start their business today now in the pandemic. But what happened if the pandemic no more? Does it still good? Sometimes, say, oh, then they have to justify. So of course, force majeure, something like pandemic can be good for certain people, sometimes, and most of the time it's bad for a lot of people. Yeah. Opportunity cost. Yeah. And what does it mean? Basically, for investors is concerned, yeah, risk of future return, I do not know. But if I put in my 10,000 in FD, I get 2%. But I do not know, if I put in money in your company, I get even 2% or not. So what's your guarantee? Again, this again all about trust. Yeah. So there's a lot of challenges when it comes to earnings in the future. But for some strange reason, this is the most method of valuation that a lot of entrepreneurs, or venture capitals would actually use to do this. When it comes to investment, yeah. So because of the fact of the value of the money today is not the same. So there is this term called present value. All right, present value of money. So I will show you. So you may have heard people say, "What's your PV? What's the PV?" Okay. So PV stands for present value, and NPV stands for net present value. So what that present value is actually tells you that the present value of the money that you receive in the future. And the formulation, if you learn this in school last time, it is the same one over and over again. So present value of money is equivalent to the FV, which is the future value, which is actually the amount of money that you receive in the future. All right. And then divided by 1 plus R. Okay, I will explain you R later. It says here rate of return, but it also means discount. It also means it could also reflect the inflationary factors. It can reflect a lot of things. Again, I will show you later what it means. To the power of the number of periods. If the money to be received in 3 years' time, then the n will be n. It will be 3. So for example, the present value of 10,000 ringgit that you receive 3 years down the road, yeah, and assuming the inflationary rate, this is not for investment, this is just to say, what was it. So normally you just do a calculation, inflation, let's say 5%. Yeah. So how much is my money today? 10,000 that I keep in my pocket, or you keep my tempayan under or you keep my vault for that matter, would worth 3 years down the road. So this is how you calculate. So if you calculate based on the 5% inflationary rate, so your 10,000 today is actually worth only 8,000, roughly in the current scenario. All right. Yeah, sorry, in the future. So that is so. And what is NPV? NPV, on the other hand, is the present value of the series of cash that you receive in the future. Let's say in the business, when you do a cash flow or forecast, you have a series of cash, right? In year 1, you receive 10,000, year 2, 3,000, then year 4, 100,000, year 5, 1 million, for example. So when you do the value of your company, the valuation, you have to calculate what's the present value of each of that particular year, so that you'll be able to derive at what we call the net present value of the company, which is actually the value that you are trying to pitch for. For example, this is again without any so-called premium or so on. Now, I'll just give you an example, and perhaps later I will go through the Excel file of the same amount, because here you can't really see how it moves. So number we are assuming year 2022, 23, 24, 25, 26, yeah, and then I just put it there numbers, because so that this is a formula for the Excel, yeah. I put one number year 1, year 2, year 3, year 4, and year 5. So assuming when you do your business, next year you don't make money, you lose money, 250,000. The year before you still lose money, but not as much as the first year, yeah, 100,000. And then you start to make your money, in your third year, 250,000. Then suddenly it jumps as high as 2 million, that jump as high as 10 million. So in total, over 5 years, the net cash that you actually earn, okay, I say here cash earning, yeah, typically where people, because I do not want to go into the detail, so I just use a simple terminology here called cash earning. Of course, in real life, people will use EBITDA, earning before income tax, interest, tax, EBITDA, depreciation and amortization. Yeah. So typically people will use that to calculate this. And in my last session of projection and forecast, I also do cover how to come up with a good projections, and forecast of the numbers. So I wouldn't go into that anymore. So yeah. So assuming these are the numbers that you derive after you have done your good effective cash flow production and forecast and projections, so you actually expect over 5 years you receive a total of 11 million, which is a net of all this number. Now, let's say the investor say, oh yeah, okay, I don't believe whatever it is, then I'll give a discount rate of 50%. I think it's discount rate. So what is the value that you receive when you want to do the valuation? So technically, of course, you put 5%, you get more. I will show in the Excel later. But assuming it's a 50%, your net present value, which is actually this plus this, your 166 plus 44,000 plus 74,000, no, minus, plus 74,000, okay, plus 385,000 plus 1 million, then it will derive at 1.5 million. That is actually your net present value. All right. So that is a calculation. That was a formula in the earlier slide. But again, you do not have to be worried, because what happens is that Excel has all these things figured it out for you. So if you use an Excel, I'm not trying to promote Excel or whatever. There are some other worksheet out there. But if you use a worksheet like Excel, for example, it can help you. Now, I will show you an example. Now, this is the same thing that you saw just now. All right. This is the. Can you see this? Hafiz, can you see this? They can see this, right? I presume.
Is it the PDF still the same PDF?
No, it's actually, so I have to share. It's a Excel. You can't see Excel, is it?
I think you need to unshare, then you share the Excel pula.
Okay. Let me try to do that. So I need to unshare or new share. Okay, can you? Oops.
So you just share the Excel now.
Can you see that now?
Yep.
Yeah, okay, all right. So it's the same thing that you see just now, but the reason why I will show this, because I want for you to be able to have some idea how this is about. So it's quite simple, right? What is the present value? If you look at here, this is the formula. Yeah. So if you can't, if you do not know how I get this, it's very easy. There's a button there that says FX. You just click there. Yeah. So you can see FX. So the rate, you just put the rate. If you don't have, in this case, I just refer to this column over here. Yeah. See, it's the same. Sorry. It's the same C8, which is this one, the 50%. And the D4 is actually the number of years, which is the number of years here. And the FV, which is the future value, is the number 250,000, right? So it's a very straightforward formula. So you do this for all. This one, this one, this one. If you look at the formula, it's the same one for every single one. And what happened is that this whole total is actually, this is actually the sum. Okay? Look at it. The sum of present value, which is the net present value. So technically what happens is that, but again, net present value is also being, I would say, helped by Excel. If you use Excel, if you click here, you have also a formula. So all you need to do is just click NPV, all right? NPV, you put in the rate, which is the C8, C8, and then you just tarik, you just take from the entire D6 until H6, yeah? So it's very simple. For example, so what you do for this one, you just tarik from here. Sorry. So you just tarik from here until here. Okay. So what you get? See, you get 1.5, same number. So this number 1574 and this number same. So you can either use formula or you can take the long way, actually do it for every particular year. In fact, you can do this to audit also. What is IRR? I will explain to you later. Yeah, it actually means internal rate of return. So basically in this scenario, what happens is that this stream of cash flow actually give an internal return of 180%. Yeah, it's 180%, which is very high. The reason simply because suddenly you have a 10 million from 2 million to 10 million. So if this is a project, for example, a concession for 10 years concession of a highway or 20 years. So what it means that these are all your cash flow, the stream of cash flow, the rate of return is 180, which means if this company trying to go to the bank actually get a loan with an interest and capital of, let's say 5%, then technically you minus the 5% of the years, you actually have a very good return of 175%. So which is actually very unlikely, you can see in most cases. All right, so just let me. Can you see this one? Can you see the presentation again?
Yep.
Okay.
Just to make it full screen. Yeah.
Okay. All right. So that's how the Excel works and so on. Now, but how do you determine the discount rate? This is always again another argument. When you come up with this valuation, so there are many factors that typically investor will look into this. Number one is the risk factor. How confident is the investor that the future cash flow would be able to be materialized? So that will actually determine. Of course, even without this factor, there will always be a discount factor because the value of money itself is already different because of inflation. Yeah. So normally there's an amount which is actually the inflation rate, let's say 3 to 5% inflation. And then on top of that, the risk factor. So they probably add another 10% of that, or 20 or 30, or even more than that, 70% out of that, because they say, oh, this is risky, So I'll actually add additional discount to this. So inflation plus discount, it comes up to a total rate of 70%. They may even say that, so it's also, so effective cash flow, and also the assumption, when they look at your country cash flow, wow, this year lost, next year lost, then 2,000, and then suddenly 2 million, and then 10 million. Can you trust this? Again, so the trust factor actually plays into role. So that is why in my last session, I actually say that when you do any cash flow, the assumption has to be solid. The assumption that you come up with when you do the cash flow has to be super solid, so that it will be able to convince your investor. You will always who want to put in money. If you come up with some hairy-wairy, some assumption that based on this, based on the market, whatever future, that is a lot of question mark, from the perspective of investor. Even though some of these are actually data based on research, but it does give some. The higher the risk, of course, the higher discount. The other one is opportunity cost, as I mentioned earlier. People will say, well, okay, this is the rate of return of whatever percent, but if I were to put in a fixed deposit, or I buy a bond, it gives me a much better return, or much less risky return. But so I say that I maybe opt to to the alternative investment. So there's and of course the other one is the market norm. There's always a market norm rate that people would normally use when they actually do a cash flow projection, like what I showed earlier, and how they come up with the discount rate, 5%, 10%, 20, 30, 40. Of course, this norm rate depends, it varies from country to country, region to region. We call it the type of investors. For example, a PE, a private equity, will take a higher discount. A venture capital, perhaps slightly less discount. A retail investor, they don't even know what discount is. They just say, okay, whatever it is, I just believe you. Some even much lesser, even as low as 5% discount can happen. Just take for example, the real value, because if they believe in you, if the investor believe in you, they just say, okay 5%, which is actually the inflation rate. They don't take any more other discount. So it all depends a lot on the market norm, and that norm varies from the type of investor, and also where you are, and what's your business nature and so on. Excuse me. Now, what is the typical discount rate? Okay. Angel round, which is typically the first round when you try to raise money. Typically, okay, this is actually the numbers that I get actually out of the internet. And this is actually the numbers that most of the, what they call it, institutional investors would actually use when they come up with a discount. And this is typically in the United States and also in Europe. In Malaysia, Asia, it's slightly different. I think it's slightly less than this, but this is typically the scenario. So angel round is about 40 to 80% discount. So they do go up to as high as 50. But in most cases, the average is about 40 to about 50%. But there are scenarios that they go as high as 80%. Series A, because you already have traction, you have some numbers that you have proven, so less risk, they go lower, 30%, or even lesser than that, depending. Series B, even lesser, 20 to 40% discount. Mezzanine, normally this is just before you actually go for your IPO, your listing, or before someone actually take over your companies, or you want to sell your companies to another party. A typical 10 to 20% discount, because from the investor perspective, they would want to be able to have some upside when the company actually goes for IPO. So they will take a slightly, lesser but more reasonable. That's something that they can tag along. So it sounds brutal, right? Especially the angel round, 40 to 80%, but that's the fact of it. So as you can see, Google could only offer, of which Excite actually renegotiated at 700,000. That was in 1999, many years ago. How many years? 20 something, yeah, more than that. So this is the truth. So have a look at it, think about it. So when people say no, your discount doesn't mean that they don't actually like your business, but the factor that I mentioned earlier actually comes into their mind before they actually talk to you. They actually come up with this discount factor, right? Now, what is internal rate of return? Yeah. Internal rate of return is straight away basically what it means is that it is the discount rate that would make the NPV become zero. Meaning that if I am an investor, I don't put a single money, meaning that I've got the full potential of this business or this cash flow. So I will get 100% return. So just now in the Excel sheet, if I were to change that 50% into 180%, then you will get your NPV to close to zero lah. Maybe I should try that so that you can have some idea. New share. Hafiz, can you see this one? The Excel sheet?
Yep.
Okay. All right. So for example, this one, if I were to change this rate into 180%, so what happened? See, all your number tukar change, then your NPV will come. Here is just negative, but it's actually almost zero. Yeah, because there's a decimal there. Yeah. So that's what it basically means. So back to. You see the slide back? Hafiz? Yeah. Okay. Thank you. All right. So that is basically what it means. IRR. Of course, there are a lot longer, more explanation for this, but I wouldn't want to go into too detail because under what scenario does typically people use an IRR or internal rate of return? Internal rate of return is typically used to evaluate concession-based projects with steady stream of cash flow or incomes. Most of the time, it is to actually evaluate or to see whether the project or the particular business is feasible or not. When you do a feasible study, whether it's feasible, so you look through the stream of cash flow and see whether, okay, it makes sense, or do I receive my money after 5 years, 10 years, So you do this, yeah. It may not even be a project. It could even be something which is a much longer gestation period that you require funding either from the bank or either from investors, yeah. So you do this, for example, like plantation, yeah. Plantation, you plant now, you get your first earning probably 4 or 5 years ago, or like durian. Now durian Musang King, yeah. You plant now, you get the durian only later. So, but then once you get the durian, you can actually know roughly, how your cash flow going to look like, over the next 10 to 15 years. Yeah. So this is normally what people do. So they use an IRR, and the reason why they use so they can compare their cost of fund against their expected rate of return from the stream of cash flow. Yeah. So like I mentioned, bankability of the project. So whether it's bankable or not, can I take loan? Or if not, what is the best mode of fundraising that I can do? So banks will normally use this. They always do IRR. Perhaps sometimes the officers don't even understand what IRR is because it's all template different. But this is what basically it means. Yeah, if you don't understand what it means. So IRR actually, or internal rate of return, not very suitable when it comes to startup, and I don't think they have not seen any. Of course, they will look at the IRR, but they will not use that as a benchmark, as far as the valuation is concerned. Normally, it's still the NPV, the PV, your stream of cash flow. Yeah. Now, this is the last principle. All right, this is the third principle. So, what is this principle? The third principle, which is actually a lot of people use out there, but this is basically leveraging on the wisdom of the crowd. Basically, what people perceive out there, the value. What is a market trend today for tech company, for fintech, for example? How does it do? And normally people will do this, by doing comparison. So they will compare either from a similar industry, from a similar business, similar type of life cycle of business, similar earning and cost structure. So some business, they have a totally different cost structure. So they will do some comparison and see whether and they will come up with some perception and I will tell you how do they do this type of calculation. So in certain terms, they refer this as invisible hand. If you learn economics, there's always this thing called the invisible hands of the economy, yeah? Which actually decide or which actually determine the perceived value of the value of the company. Now, what is the method? Typically, the method that people use is PE ratio or PE multiple. I think many of you may have heard this, and many of you probably try to use this also. You come up with the earning and say that my profit forecast is 10,000, 1 million next year, and I will want to actually multiple by 10. So my valuation of the company is 10 million, which is actually 10 times PE. And most of the time, they will not compare with they will compare with this 10 times. Actually, how do they get it? They get it from either Bursa. They will compare with the PE multiple of those in the public listed company in Nasdaq, in London Stock Exchange. So typically, most of the time, actually, if you ask me, PE multiple may not even reflect the true value of the company. It's actually, again, is driven by market sentiment, is driven by a lot of other factors. For example, you will see companies that are actually making loss, but people are willing to buy at a much higher rate. Okay, so you imagine when a company say that my PE multiple is 10 times. Okay, 10 times. What it means is that I will pay 10 times. You said your forecast is 10 million, 1 million, and you value your company 10 times, which is 10 million. If anybody wants to buy that at 10 million today, what it means that I am an investor. I pay you 10 million because I'm willing to wait for 10 years to receive back my money. That is basically based on your forecast of next year. I'm willing to wait for 10 years. But in the real world, if you ask me, nobody will do that. Am I right? Yeah, nobody will actually do that. I say that I will wait for 10 years. So imagine a company that actually go in the public listed out there and say that my PE, the PE material is 20 times, 30 times, or even 100 times. A company like Facebook, without even earning, is valued as much higher over the negative earnings, 40, 50 times. But in actual fact, what happened is that if I take that company now and I strip it off, the asset and the liabilities, I get zero or negative. Yeah, that is typically the scenario. So even a company with proper NTA, that is why if you look at the Bursa Malaysia or in the public sector company, if you look at the NTA or the net worth of the company, it's perhaps only, let's say, 10 million ringgit. Yeah, 10 million. But the value of the company today, the market capitalization of the company of today, probably 200 million, which is 20 times than even the actual value of the company, which is something that you can strip off. Meaning that if I take the company, if the company liquidate today, I can only get back 10 million. So you imagine an investor that put in the value of, if they buy the company of 400% and paid 20 times of that. So in real life, definitely, I would say in real sense, I wouldn't say in real life. Real life, that happens. In real sense, nobody will make sense out of it and they will not do it. But we are today, whether you like it or not, we live in what I personally would call a derivative-driven economy. Derivative-driven economy means that most of the value are not explicit, it's intrinsic, which is actually based on derived or derivative. So again, the value of the company could actually be only 100 million, but because of how the entire derivatives market actually works out there, that it creates all this perception and perceived value that actually get this company become more liquid and listed out there in the stock exchange. And because of that, then actually your value become higher. Yeah, and people trade this value. And this is the same thing goes to the currency. Yeah, that is why last time we actually plot, or actually we we were doing the capital control times in the early 2000s. Malaysia actually, locked our currency exchange into 3.8 against US dollar. You know why? Because people will start to speculate. Yeah, people start to speculate the value out there in the open market, which doesn't reflect the true value of the currency itself. Because the demand is there, the supply is there, people are still using ringgit, but because someone out there is actually using the stock market or the currency market to actually play around with it. So the same thing with the bursa. The fundamental of the business of the company may remain the same, may even be good, good revenue, good stream of income, but because of the perception or some reason, some news, then the value will go down. So this is actually most of the time PE multiple is normally used in, I would call the stock market, and open market, and also used for the purpose of acquisition. Very, very seldom people use this, especially in the international arena of venture capital as well as PE market, that people use this for the purpose of investment. Yeah. So there are three things just now that if you can remember. When it comes to NTA, people normally use it when it comes to liquidation. For PE multiple or future value of money, people use it for the purpose of investment, while this perceived value, people use it for acquisition because they perceive that if I buy this at this value, although it's high, I perceive that in the future I can sell it at a higher rate. Yeah. So that's the principle. So it's actually, so PE multiple is widely used. Again, I mentioned it earlier just now already. Is widely used as a stock analysis tools by investor and market analysts to determine the stock valuation. Actually, not to determine, to have a gauge of the stock valuation. So it does do comparison so that they know comparatively whether it's overvalued or undervalued. So every morning, the analysts of the securities company will come up with a report and say, and come with a report and say, okay, buy, because we believe this company has a good value, or sell, So there's always that. So if you subscribe to some of this, what they call market intelligence group, then you will keep on receiving this analyst report, and they will talk to you about the PE multiple, NTA, they do some comparison and so on. So this is what it means by comparison. Basically, as I mentioned earlier, it shows how much investors are willing to pay per dollar of earning. If a company is currently trading at a PE multiple of 20, what it means that the investor is willing to pay ringgit Malaysia 20 for 1 ringgit of the current earning. So like I say, in real sense, it doesn't make sense. But in real life, that is happening. And that is only will happen when your shares is actually liquid. Yeah, it only happens when your shares liquid means that you can buy and sell in the open market. If your shares is already listed in the Bursa Malaysia, because it's liquid, I can sell today, someone will buy either at a lower price or the higher price, then PE multiple normally is being used for that purpose. Unlikely it will use for any other purpose. So what market is willing to pay today for the stock based on it in the past, future, I mentioned that earlier. So again, like I said, normally this is used for acquisition and not used for investment or even for liquidation. So kalau liquidation, if they use the gone case, you imagine company that only can, after you asset minus liability is only 10 million, but it's been capitalized in the market, traded in the market for 1 billion ringgit, for example. So it won't work. Yeah. Now, the setback of the PE multiple, again, I already mentioned it roughly earlier, it can change dramatically. It can change dramatically from industry to industry, or even from the same industry for that matter. Yeah. So that's why you can see, the stock market, is always like a roller coaster, or even for a matter like Bitcoin, it's derived value. It's not really, it's a perceived value. It's never the real value. It's never something that you can actually, be able to strip it off, asset liability and actually be able to sell back. Yeah. So because of that, it's actually driven by speculation. It's driven by sentiment. Yeah. Sentiment. So it is actually very sensitive to the market sentiment. And the problem with the market sentiment is very fickle, sometimes very irrational, and most of the time it's also uninformed. Although, that is why the market tools that people normally use is also, for example, the news, the analyst report, so that they get informed information. And again, most time also is driven by emotion. Yeah, it's very emotional. So if someone just say sell, then everybody will follow. Oh, if someone say, let's say in Malaysia, who are the biggest investor in Malaysia? Perhaps, for example, EPF, PNB. Yeah, these are the big fund that actually invest in the stock market in Malaysia. So some investors, some traders, what they do is they just follow these big boys. They just see whether, you know, wow, what is PNB buying this year today? PNB suddenly buy, you know, this market stock. So suddenly everybody will buy because hey, there must be something good about this company. Sometimes it may not even be the case. Sometimes it's just, you know, maybe the broker on that particular day wake up and say, I like this company now, just go and buy. Then suddenly the whole market, you know, buy the particular stock. So again, it's very much driven to it doesn't really reflect. Yeah. If you remember, about 20 years ago, you know, .com companies used to value more than 20 times. No, when I talk about 20 times, at that point in time, people even value company even they are not listed. Okay, even they are not listed, they value company and say that no, my company is 20 times, and people buy because it was a what do you call it? It was a bull run. It was a bull run in the market that people are willing so much. Today, you know, some of this .com company even value less than 10 or even value less than 5 for them times for that. Some of them went for listing, it value much lesser. Yeah. So when actually, as mentioned, sometimes the business of the company doesn't really change. Sometimes it's still good, but because of the hype surrounding it has changed, so the value of the company has also changed from very high to become even lower than NTA. So there are today, if you look at the stock market today, there are a lot. If not, maybe not today lah. Once upon a time, maybe about study a year ago, more than a year ago. If you go to the public listed company, if you take their what they call it, they take their accounts. Yeah, if you take their audited account and you look at the NTA of the company probably 100 million. But the value, the market capitalization of the market cap of the company is only 50 million. You imagine that? So meaning the value of the company is much lower than the NTA of the company, which means that if I buy 50 million of this company, I can easily make, and I close down this company, I immediately can make another 50 million profit out of nothing, out of the air. So that's what it means. If you watch those movies last time, Richard Gere, was it Richard Gere? In Pretty Woman, yeah. So he always say that now, what do you do? I buy company, I strip them off and make more money. So this is exactly what happened. So when the company is traded so low in the market, there are a lot of market raiders out there who will just buy this cheap company. And what they do, of course, in Malaysia, you can't do that because we are highly regulated. But once upon a time, even in certain market in US, people does that. They go and raid all these cheap companies that just go down. And sometimes they do a lot of market, what do you call it? Yeah, market raiding that push the value of the market down because the company also is good. The company is doing very well, but then the value of the market that is traded in the stock market, you know, actually goes down much lower than their real NTA. So what happens is that when that comes, some nasty raiders will just buy the entire company, you know, for 100% or a controlling stake of the company, and then just sell off everything. Yeah. When they sell off, they say, I just sell at NTA. They make immediate money. So again, I said, no, this is something that rarely applies, but I wouldn't say it doesn't be applied at all. Maybe it will be used as a gauging factor. For example, say, okay, certain companies already listed at PE multiple. My NPV value is so much, you know, maybe there's premium to this, or there's a discount to this that I want to actually be able to negotiate with the investor. All right. So that is PE multiple. As I said, now many of you have heard this, and many of you will try to use this, but in most cases, from the perspective of investors, especially institutional investors, it may not be something that is accepted or easily accepted by them. They would still prefer the investment mode rather than the acquisition mode. Now, like I promised just now, I'm not so sure how much have all of you absorbed some of these presentation. Actually, this is my last slide, so I've got quite almost 45 minutes to go through any questions. if you forget everything else, do remember this. The value of the company is actually what you own, which means the asset minus its liability. And typically this is used most of the time in a perspective of value liquidation. But again, all these things doesn't mean that it is not being used for a startup. It's just that it can be a combination of some. It can be used for gauging or negotiation. But most of the time people still use a second one, which is actually what you earn in the future, which is your net present value based on your forecast. And again, if you missed my earlier track on this forecast and projection, do find out from MDEC, if you can be able to go through that from the recording. What the market says, as I mentioned earlier, these are the PE multiple. Typically, people use this for the purpose of acquisition. Again, on the perspective that there is a potential upside. So when investors agree to actually based on PE, any investor wouldn't want to put in money and tomorrow lose. Yeah, they want to put in money today. They bring in either they buy from the existing shareholder or they invest the money into the company. At the end of the day, there is something that they are looking forward in the future, and that is always in this so-called capitalist economy. There's always a profit element at the end of the day. Yeah, I do not want to go into detail into whether it's capitalist or social, but at the end of the day, that is the scenario when you actually talk to your investors, when you talk to people who want to fund your companies in this respect. So I guess with that, just go through very quickly about Atta Plus. If I don't do this, it'll be a sin. So who we are? We are a licensed, what I call equity crowdfunding operators, which is registered and licensed by the Securities Commission. We got this in 2015, and we started our business in 2016. So our aspiration is actually to democratize wealth and financial inclusion in this new economy, and we believe that actually one way to do this is to mesh between entrepreneurs like yourself to the potential investors that who wants to actually be able to invest or has a belief in the business that you are in. So what do we offer? Basically what does crowdfunding means? Actually, you get your company. Okay, before I just for your information. Okay, in a typical Sendirian Berhad, if you are a Sendirian Berhad, you cannot go out there and pitch to more than 5 people. To invest in your company. It is illegal to do that because you are considered as publicly soliciting investment. All right. That is why, if you want to do that, you can, but you must be a public company. If you are Sendirian Berhad, you're a private company, you cannot do that. So what does public company mean? Meaning that your company is traded or listed in the Bursa Saham Malaysia or in the DBKL. And BSKL, KLSC. Yeah. So if you are listed, then you can do that. You can have 1,000 shareholders, you can have 2,000 shareholders. Yeah. But under crowdfunding, if you are a Sendirian Berhad, you are allowed, or it is legal for you to go out there and shout yourself and say that, and talk to 100 people and say that, hey, all 100 people, I have this business, I like this business, my business in the future is good. Please come in as investor and put in money in my company. You can do that by using an ECF platform just like Atta Plus. So if you have watched the movie like, I don't know, the TV series like Shark Tank. So Shark Tank, you may thought that this guy that pitched their business is actually pitching to the audience. No, they don't. They just pitch to the 3% that sit in front, which is normally less than 5%, because that's the only legal person that you can pitch on. The rest of the audience are just there to show, for show only. So they are not allowed to invest in your company. So this guy are not allowed to actually pitch to the crowd. They're only allowed to pitch to the person, to the investor that sits in front. Okay. So the same thing in Malaysia. You cannot pitch to more than 5 people. Anything to you do that is actually illegal. So because of that, the government under the Securities Commission come with the license, to allow a platform like us, to allow a company like yourself, a Sendirian Berhad, to be able to solicit investment from the public, from the crowd. Yeah, of course, he has to comply with certain requirements, yeah. So what we do a very swift process. What makes us different, which we believe, again, what makes us different from a lot of other people. We process your application, you process your onboarding much faster than very well. And we do a very diligent compliance. We provide value-added services, which means that we also market you. We bring in the potential investors to you. We provide, during prior to the pandemic, we actually organized a pitching session whereby we call all the investors from various parts of life, whether it's their individual angels, M-band members, or even VCs and private equities fund that comes to our that event and actually do it. Now it is during the pandemic, so we do it online. So we actually will help you. We do all the services. At the same time, we do all other offline services like the PR marketing, even for yourself and also for the platform. A quick one. I'm not so sure whether you know any of this person. The one on the left is Tan Sri Abdul Samad. He used to be also for a very, very long time the president of the Malaysian Institute of Accountant, a very prominent person. He was in Bank Pembangunan. He was in MEFCAP, MDV. Yeah. So he's our chairman. I know who is also an audit committee member of the Petronas. He's one of our angel. Okay. What do you mean by angel? So he's one of the person who invested in, actually these two prominent gentlemen, was one of the earlier person who believed in Atta Plus, who believed in our aspiration, who believed in our business. You were also what startup once upon a time. Yeah. So they believe in our aspiration. They actually invested money in our company at a much lower valuation. Yeah, for your information. This is us, the founders, myself on the left, Elaine, who is our CEO, and Kiri on the very right-hand side. We take care of various different profile and portfolio. Myself, with the various background of finance and legal, I would look into the investors management as well as regulatory compliance. Elaine, being the CEO, predominantly looks at almost everything, and Kiri, who has been in the marketing branding arena for many years. He used to be in a Betty advertising, Dentsu, Young and Rubicon, Saatchi and Saatchi. So these are the big brands that you can think of that he used to be. So it will be an honor, for us to be able to help any of the entrepreneurs out there and to be able to use all our skills to be able to help you. Yeah. So the Atta Plus platform, okay, so you can go to our website. Yeah, you can go to our website. It's www.attaplus.com, and you can see all the deals currently. So when I mentioned just now, you can pitch to the public, so you can actually get yourself company listed. You can see in our website, So all these companies are the companies that actually manage, get themselves listed on Atta Plus. We help them to get investors to come in. And they manage to actually, fundraise. Of course, it's not always 100% successful. It all again depends on you, how you do your valuation, because we don't do valuation per se for you. So you have to actually be able to do that. So you'll be able to pitch yourself, to sell yourself to the investors. So most of the time, people who are good at this, they will win. They will be able to be successful and be able to fundraise in any ECF platform. So that's pretty much it. I guess I pass it back to Hafiz for any question and answer session. I think we have about half an hour.
Yep. Thank you very much, Aimee, for that presentation today. So yeah, I think we can move straight to the Q&A session. And if anyone has more questions, do post it in the Q&A box at the bottom panel there. I know some of you post in the chat box. I'll try to get as much as possible from there. But if possible, just post some questions at the Q&A box there. So okay, I think we can go for the first question from Fong Wai Leong. For internet companies, people value based on views, subscribers, base, and traffic. How do these works?
Fong Wai Leong, I'm not so sure whether this is a Fong Wai Leong that I know. I thought you should know this better. Anyway, question. Fong Wai Leong, if the Fong that I know, he used to be my colleague before in CIMB. For internet companies, people value based on views, subscribers. Yes, they do. Like I said earlier, As much as people value company based on future earning, because future earning they also view based on traction. Okay, but like I say, most of the time when they do this on the pretext they are going to get themselves listed, or they are going to get themselves be acquired by a listed company. For example, there are companies who says that no, my plan is actually to be able to acquire 1 million subscribers in 1 year, and 2 years down the road, or 1 year down the road, I've already talked to, let's say, a company in spec, to acquire me, because spec company, they may not even need your revenue yet or your earnings, they just win the numbers because they are listed companies. So that typically the scenario where it works. But of course, 20 years ago, people use this. Like I said, like in my presentation earlier, 20 years ago, people use purely on traction, purely based on subscribers, based on the audience to value the company. But I think as of today, there's always that element of a risk that most investors will look into. So I wouldn't say that people don't use it at all. Yes, they do some comparison with the existing companies to gauge the value, but to explicitly be able to quantify that, it always be a challenge. Yeah, and it's not easy for you to be able to do that. Of course, again, depends on the investor. Of course, you do have various type of investors. For example, there are in those days investors or the funds like SoftBank, when they acquire Yahoo has almost nothing, but because they believe in the vision, they bought it at a very high value. That was 25 years ago. Yeah, we have people like Sequoia does that too. They buy a lot of fintech internet-based company purely based on tractions. But I'm not so sure exactly how do they do that valuation. But we do see that. But I guess at the end of the day, it's also a combination of everything else, including the future forecast of your company, how much you can get. But if your clear exit is going to get listed, yes, predominantly people use that as traction and come up with a value and actually do that.
Okay.
I hope I answered that, William. Actually, you can ask me personally.
All right. So okay, I think let's get some simple questions out of the way. I think are the slides available for the attendees and the Excel template just now?
You ask me, do you ask yourself? Yes, of course you can. I can give it to MDEC, I leave it up to MDEC to be able to distribute this.
Okay, right, sure. Okay, number 2, let's go to the next question. You mentioned when doing financial projections that we use EBITDA. Why not use FCFF? Not sure what is FCFF.
FCFF, enlighten me what that is.
Yeah, I think I too do not know about.
Okay.
But okay, maybe the the attendee can mention somewhere. Okay, I think let's move to the next question. Okay, this is from Sharma. Earlier you spoke about how to look at Google or X and Y or some comparables during the same race round. But being in Malaysia, how do we manage for market discount? Most multiples we see are Americans. So and Asia seems to be a very different animal. So yeah, how do we manage that? And I guess I want to add something to that too. Like raising from a global investor, right? And you only have I mean, is it fair for you to compare to yourself, to the American market, or would that be more useful if you compare to the Asian comparables?
Okay. Right. I guess comparison is always, it is an art. Yeah. Okay. This is where the art comes in. I mean, if your business is predominantly, that you intend to do actually in Malaysia or in Asia or in certain countries, I don't think that is, first of all, is comparable. Is comparable for you. It's wise for you to be able to compare it for those elsewhere. Yeah, because then the investor won't be able to make sense out of that. Yeah. So, but of course, if you say my business, the business that I'm doing and I'm building is actually a global business, and you'll be able to convince the investor that you are be able with your roadmap and the thing that you're going to do, you are able to do that. The resources that you can acquire, you'll be able to do that. And it is not impossible to do that. Yeah. But having said that, even companies like Grab doesn't go international per se. Yeah, it doesn't go in the Northern America or even Europe for that matter. But they have be able to gain certain value out of the business. So what I say doesn't mean just because you value yourself with the American and Europe you can get a better valuation. No, it's all about business. If you be able to convince, you'll be able to track it. Yeah, then yeah. So again, the question is whether should you? It depends. Again, your business and how you manage that. Again, even if you talk to the global investors, I guess the Northern Gate or Sequoia, all these likes. When they come to Malaysia, they will look at it from the Malaysian perspective or the Asia perspective, and they look at it from the business. They will not even compare, with the like of any other business that they invested in the States or even Europe. So I guess you need to be reasonable to yourself at the end of the day, when you do it. So always look from the business perspective and out, not from out and in. Yeah, you look outside there and then you berangan-angan, then you say, okay, my value that one 20 billion, so mine is 1 million. What is that? And I compare that. So I doubt that can happen, and I don't think that will happen. Yeah.
Okay. All right. Thank you for that. Next question. Okay, so just now I think we go back to the previous question. So the question was, you mentioned when doing financial projections.
Free cash flow.
Yeah.
Okay. Okay. Actually, free. Okay. EBITDA technically is also okay. If you do a cash flow, if you were in my earlier session, it's actually a free cash flow. Okay. What does I wanted to come down with this actually, but somehow I think I missed that in the session. Okay. What does a free cash flow mean? You can use free cash flow, and frankly speaking, if you ask me, most of the time, if it is a project based, I will use free cash flow to do that valuation. But if you are a company because you do have a lot of accruals and things like that, right? So normally EBITDA is quite sufficient to be able to gauge that number. But technically, a free cash flow means that you assume that the company cash flow which actually EBITDA and without any other elements of loans, any element of capital injection. So you do a free cash flow. Yes, the answer, you can use free cash flow. And most of the time when you do free cash flow is more on project or concession based. When you want to calculate IRR and things like that. Because when you do free cash flow, you assume that there's no other element. Of course, EBITDA, you take out the depreciation, you take out interest, you take out all the other non-cash elements. And also you take out the funding element, which is actually you have any loan, because if you do a typical cash flow, when you add on the loan or capital, then your bottom line will always be positive, right? But if you do a free cash flow, actually just now what you saw is technically almost like a free cash flow, because you have a negative, in the early part, which means that it is funded by someone, either from a loan or even from capital. So that's why you have a negative. So yes, the answer, you can use free cash flow, but I did not elaborate that just now, what it means by free cash flow.
Okay. All right. Okay, let's go to the next question. Does IP or software considered tangible or intangible asset?
That's what, sorry?
Does IP or software considered tangible or intangible asset?
Okay, IP. IP means intellectual property. Technically, IP is intangible in general. And those IP that I mentioned earlier, trademarks, copyrights, patents, those are IPs, predominantly. So IPs is considered as intangible, unless it is, software. Software, again, if you build a software, normally there's a cost. Either you get someone else to do it, then there's a cost. But if you say that my software valued at 20 million, then that is not intangible. That is actually, you are actually predicting that you will be able to create value out of your software in the future. And because of that, you need to come up with cash flow. You need to come up with your free cash flow. You need to come up with your EBITDA, for example, your earnings, and then you come up with the valuation based on that. You don't base on what you call the software valuation, the whatever it is, no, is that a bit hard again for most investors to be able to do it, because just come out a number from the sky won't do it. Then you will say, okay, if your software is good, so how much can you actually be able to grab earning out of your software? Yeah. So yeah, it's intangible unless someone else, for example, in the case of Microsoft, I can't remember the exact number. If I remember, when they bought the DOS, yeah, the DOS was actually value at much less than 10,000 US dollar at the time, and they bought it at 16 US dollar. And this guy who actually sell it was so happy because he was trying to sell less than 10 US dollar, and Bill Gates bought it for 16,000 US dollar. And what Bill Gates did was, see, yeah, what happened there? The software, maybe it cost that guy only 200 ringgit, you know, to do it, but he managed to convince someone at less than 10,000 ringgit. But because Microsoft was so desperate, who wants to actually at that point in time wants to sell this idea of licensing to IBM. So he went there and actually offered 16,000 US dollar, and this guy was so happy without question. So he thought that he gained. He made the deal of his century lah, of selling 16,000 DOS, the diskette, which is this operating system, to and this guy signs a agreement that no, he cannot claim anything from Microsoft or Bill Gates anymore. So what Bill Gates did was he take this DOS and actually license it to IBM at the time, and he made millions of dollars out of that. That is why I mentioned earlier, Microsoft from the very beginning, they don't need the money because he is so smart, being an entrepreneur, to actually be able to negotiate the best deal out of there and actually be able to create a better deal out there, you know, with IBM and make money, you know, 2,000 times more than what he actually buy. So yeah, I hope that answered that question as far as software is concerned.
All right. Okay, this question is from Afifa. With regards to the price to earning ratio just now, what if PE is negative, and most startups do not disclose their PE?
You mean earning negative or PE negative? Okay, I think
means PE lah.
So I guess the earning is negative here lah, yeah, I presume. So what you're saying is that your earning is if your earning is negative, let's say if you saw my cash flow just now, yeah, you may have a negative cash flow in your first year, second year, but if you continue to have a negative PE for the next 20 years, who wants to put in money with you? Because unless you tell them, they said, even though I have negative PE for the next 5 years, but because like what Mr. Fong Wai Leong answered just now, question just now, unless you can convince the investor and say that, yes, for the next 5 years, it will be negative, okay? But because over the next 5 years, I want to actually be able to have 20 million subscribers around the world. And because of that, in the third year, I'll be able to actually offer this to a SPAC company or get this thing company listed. Because listed company sometimes doesn't really go on earnings, especially when you go to NASDAQ. You don't need earnings, right? It's all about perception. It's all about emotion. It's all about, you know, what you investor believe and how much they can be able to trade. So that is why PE multiple is normally being used when you actually have some intention either for you to go for listing, to get yourself listed, or I believe a lot of people at the end of the day, you do one, but either you want from the perspective of traction purely, or you want from the perspective of actually earnings for the company and for your investors. Because most of the time, people who actually invest in company that has no earning but has a potential to be listed immediately after 3 years, there's no way they can get dividend of the company. There's no dividend because it's always lost. Yeah, but they be able to go and speculate that out there in the market, or be able to trade it in the open market, and make money out of that. Again, this is a capitalist economy, so it's all about profit.
All right. Okay, we have a couple of questions on ECF, particularly. Okay, so number one, what is the pros and cons of ECF platform versus the usual seed or normal VC investments? Any reasons why founders prefer ECF compared to VC investments on normal rounds?
Okay,
And
yeah.
the second part of the question is that can valuation drop from the ECF platform to the VC's point of view when a company wants to raise their next round with the VC?
All right. So the first question, what's the pros and cons of ECF platform versus usual seed series where you actually get the money from venture capitals or any other type of or PEs? Yeah. So what's the difference? For the ECF, normally it's slightly much faster for you to be able to raise. Why? Because you are actually pitching to the public, yeah, to a lot more people. So your value or your business valuation, your business potential is validated by the public, by the people of the crowd. If you go to a venture capital, whether they believe you or not is validated by themselves. Okay, so which normally takes a much longer time. So a typical VC, a typical PEs, they have their own internal process to go through a due diligence. Let's say they will go through diligence to you. They strip you off almost everything, your asset, your liabilities, your accounts, your businesses, everything. They will find out everything, and then they will come up with the paper. It will take time for you to do the paper, and they will need to go through a process of approval, and then they have to go through process of actually perhaps interviewing you, talk to you, and negotiate. And then this negotiation will take also time because there'll be a few rounds again of negotiation. So the whole process may take more than 6 months, 9 months, a year, or even a year for that matter. And this is not just in Malaysia, yeah, it's almost everywhere in the world is the same thing. Whether you're in Northern America, whether you're in Europe, whether in Japan, Australia, or even China, that matter. Yeah, so it's the same thing. But in the ECF, you actually offer that to the public. You go onboarding, for example, in Ata Plus, will probably take you about a week or two maximum, and then you can get yourself listed, and then the crowd will validate you. Whether they believe in you, they believe in business. Of course, you will have all the videos, to pitch yourself, to be able to tell about your companies and things like that. They look at your document, they look at so they will validate. Yeah. So those are I would say, the glaring difference between an ECF and going straight to a venture. I'm not saying that which one is better. No, I just say that it is a different perspective altogether. Yeah. I would say most of the time from the VC perspective, you may get much higher in terms of investment, but they probably also ask higher dilution from yourself. Yeah. Or they would prefer a convertible 100% than actual investment. I mean, there are many types of tools. So as you know, in investment, in fundraising, there are many types of tools. There are ordinary shares, there are preference shares. Now there's a SAFE, there's a warrant, there's a convertible notes. People can use that. In fact, perhaps this is something that MDEC may want to consider. This is another what you call the tools on method of how people invest. Yeah. So yeah, it all depends. Number two, the question: can valuation drop from ECF platform to VC's point of view when the companies wanted to raise? Okay, now it all depends. It all depends on the company. Okay, it depends when there's the next series. Okay, in fact, if you ask me, we already have quite a number of situations. Okay, I can't remember the actual valuation. For example, if you look at Ata Plus, there is a company called, when we started about 4 or 5 years ago, there is this company called Mekapan. Okay, so they do online, online. Actually, all the teams are all in Malaysia, but their market somehow in Asia, and they started in Indonesia because it's a bigger market. Yeah, so is a what you call it? So what they do is, when I can't remember, but we have a look at it. When they started in Ata Plus, they value a certain amount, maybe I can't remember, 1 to 2 million ringgit also. But today, when the investor, they just had their series, again I can't remember, series A or series B. I think series A. They had their earlier fundraising also after us, and this is their series A or series B. Their valuation is much higher. So far, why? Perhaps again, they are from the day when they fundraise in ECF until now, that's about maybe 3 to 4 years. Yeah, when they had the first fundraising after ECF was about a year after that, and that was actually a much higher value. And then they had Series B or Series A, even much higher value because it was validated by two series, by ECF, by the first investment, and also the Series A or Series B. Yeah, and we also had a scenario like purely B, same thing. They value a certain amount, and they had their Series A or Series B at a much higher value. So, but of course, again, why they had that? Because they actually proven themselves from the fact that they get themselves listed in Atta Plus, and from the day they actually raise a new one, the performance doesn't go like that. It just doesn't go like that. If after fundraising in Atta Plus, then suddenly you use your money to buy Mercedes, whatever, or buy a house, and then pop. Then if you try to take another series, of course nobody will put in money to with you, because they will still look at, of course, you were very high at Atta Plus, doesn't mean you'll be able to get a higher valuation because your traction doesn't say so. Yeah. So actually, so far in Atta Plus, I have not seen that goes down. Of course, we have seen scenario whereby there is a tussle a bit. So I give you an example just now. Investor come in, then suddenly there's a tussle. But then today, that company goes on very, very well. It has been put in more money. So again, because of the performance went very well after the ECF.
All right. I mean, just to add to that second part of the question just now, I think it's always possible, for your valuation to go down for the next round. I mean, we call it down rounds, right? But being in ECF doesn't necessarily contribute to that, lah. I mean, it's all about how you live up to your valuation.
To promise, and also to your promise.
Yeah, exactly, right. If you set a price in this current round, then you go to the next round. If you live up to that value, then it's fine. So being in ECF doesn't necessarily affect that valuation or down rounds and so forth. Yeah. Okay. Next question again on ECF. How much is the maximum funds can a company raise on any ECF platform in Malaysia as per the regulations? And how much is the typical dilution that would happen in that company?
Okay. All this question, it all depends on the company. It depends on the entrepreneur. It depends on how they perceive that investor will be able to actually invest in the company. Now, what is typical? First is how much. How much? What is allowed by SC today is up to 20 million. You can raise. Okay, when we first started the under SC guideline, or actually under the Capital Market and Services Act, you can raise 5 million, but for each campaign, maximum 3 million only. Then, if I'm not mistaken, sometime before this, in 2019 or something like that, they allow up to 10 million ringgit. 10 million ringgit. Today, SC allow up to 20 million ringgit, which is almost similar to predominantly what a public listed company try to do when they, when a company goes for IPO. When a company goes for initial public offering, normally they will raise about 10-20 million ringgit. So now you can look at it, you can even do that on a ECF if you want to. Yeah. And what's the advantage? If you go public, then you are under the scrutiny of the authority lah, because you are a public company, But if you be able to successfully be able to raise 20 million and maintain a Sdn Bhd, I think that is even better, because you can even raise 20 million and you still maintain a private company and not a public company. So that is to answer the first question. What was the second question? Where is it?
How much is the typical dilution?
Oh, dilution.
Yeah.
Now, dilution, we've seen from as low as like 5% to even 30% dilution. So it all depends on the value. If you say that your company value at 5 million and you want to raise 1 million, then you'll be diluted 25% or 20%. Yeah. So of course, sometimes people, that's why there's a lot of entrepreneurs, what they do is, because they're afraid to be diluted too much. So what they do is, they go at a very high valuation, like 20 million, and say, I want to raise 1 million ringgit. So because of that 20 million, then your dilution is only 5%. Yeah, but it doesn't work that way. You have to really look at your business, what your value is and how much you are willing to actually. But again, having said that, you can also go on a preference shares, which means that you don't have to actually be diluted from the perspective of an ordinary shares. Yeah. So there are many ways of how you actually fundraise, which is not necessarily through an ordinary shares where you will be highly diluted. Some you can dilute now more, some you can dilute a bit more and dilute a bit more later. There are many ways of doing this. Again, that's why, maybe next time we can have another session just on the tools and mechanism of fundraising, because there are many products out there. There are many ways of how you do this. Of course, the typical one is a loan, and then you can do equity crowdfunding, which is actually ordinary shares, but you can also do equity crowdfunding on preference shares. But also, if you go to a corporate finance company, a bank, they will come up with another. You go to people like Goldman Sachs, you go to Morgan Stanley and everything, they will come up with another 20 different type of products that you can fundraise, and it can be either equity, quasi-equity, or purely loan. So yeah, so I hope that answered your question.
Okay. Okay, what is the best projection to forecast our valuation in terms of the valuation period? Either, do we project for 5 years, or do we forecast more than that? So yeah, what is the best period?
Okay, it depends. Again, a lot of this depends on the nature of your business. Of course, if you do a durian plantation, you cannot project 5 years because you only get your first buah, in the 4th year. Yeah, so you have to go a project of like, the life cycle of your durian. Okay, for example. But of course, if your business is a lot of your business is actually something that you can build over the next 3 years, and it takes you 2 years to 2 years gestation, and actually be able to build from there, you probably need up to 5 years. Yeah, I wouldn't say that typically you go anything beyond 5 years, because not many investor or not many fund, a PE fund or any mutual fund, whatever, to be able to wait too long. Most of the fund has its own, what they call it, tenure. Most fund has a tenure of, I think, around 7 years typically. So when they invest their money today, they must make sure that their investment be able to recoup back and with some profit of, let's say, 2 times, 3 times, whatever it is, or 5 times or 10 times, by the time the fund expires, which is actually 7 years. So typically, if you're targeting, for example, like venture capital or fund or PE, there's always that limitation, because they will look at it from the time of their own tenure of their own fund. But of course, if you go for angels and things like that, they will look at it differently. But also there are other factors like, I said, your business nature. If your business nature, but if you say your business nature takes 10 years of gestation period, you will scare any investor away from the very beginning. Say, yeah, before you even can, your gestation 10 years, I don't even know whether I leave or not. So it all depends. But I would say a good 3 to 5 years is nice for most businesses, but may not apply for all.
Yeah, I think it's basically, telling the investors too, like how long can you give them their returns? Right? If you project for 10 years, telling the investors that in 10 years, then you get your money back, right? So if you forecast for 5 years, then I think that's a bit more on the safer side, I would say. Yeah. Okay. I think Gerard has a question also on the ECF. So what is the application fee to ECF with Atta Plus? And you mentioned the onboarding and listing on Atta Plus takes about 2 weeks. So what about the duty? How long does that take? And also, okay, let's do that first. There's a second part to that question, but let's do the first part first.
Okay, the first part of the question, how much our onboarding fee, whether you decided to proceed or not, but the moment you want to onboard, it's 4,888. So again, that's another advantage of compared if you were to go for listing. It will cost you at least, before you even start talking to the banks, they will charge you 500,000 or 250,000. You must pay upfront. So in our case, 4,888. And then the rest are all success fee. Success meaning that if you will be able, your success is your campaign successful, then we will charge our rate card. I would say our rate card that we publish, I would say complete the one that we have, or even allowed by Securities Commission, is 7.5%. Actually, 7% on our side. Of course, we do have a third-party cost like the trustees, because when investor put in money, they don't put into your company straight away. They will put into a trustee account, and that trustee will also charge. That's about 0.5%. Okay, so there are other, let's say your what do you call it? Some of them will use credit card to pay. Then all those charges will be your cost lah, the investor, the issuer's cost. So basically 4,800 plus success fee. Those are all your costs, 7%. But of course, it depends. If you raise more money, we can always negotiate. Everything that I say, except for 488 lah, which I think is quite reasonable, in the market. Most of the time, the percentage of the success fee is negotiable. What's the next question?
So the second part of the question is that, can you reshare your thoughts on the industry multipliers for startups with regards to deriving a valuation?
Can you reshare your thoughts of industry multipliers? Oh, okay. How much is the PE multiple for startup? Is that the question? I think if you were in my actually, typically, not many people will use this as a explicit valuation for a startup. Yeah. PE multiple, again, as you normally people use it for acquisition purpose, or if it is clear cut that you are going to get yourself listed somewhere, you have an exit plan, you have a proper exit plan for the investors, so that they're convinced that you can do that. But of course, you can use multiple to gauge. For example, because the fact that like I said earlier, if you are in my see, the problem with the PE multiple, it can be 200 times today, then tomorrow it becomes 10 times, because there's a lot of elements of emotion, market sentiment, this invisible hand, perceptions, news, sentiments, everything. So all these matters affect the PE multiple. I mean, of course, the best way for you to see what's the market today, you go to the BSKL, KLSC, you look at the PE multiple of that particular industry. That is your comparable. But other than that, typically, I would say, I mean, I wouldn't normally use PE multiple in that sense, unless there's clear exit, in terms of that. Yeah.
Okay. All right. I think we've come to the end, but I think we can do one more question. I think it's a very simple one. Is Ataplas Sharia compliant?
Is Ataplas Sharia compliance? Okay. When we actually applied for the license or for the registration with the SQT, we do apply for Sharia compliance. But at that time, SC do not have so-called Sharia compliance. But what we do actually, we do have Sharia compliance product, which is vetted through by a proper certified Sharia counsel or person. And we only deal with Sharia compliant products and issuers, which means that if you are in the gambling business, then we don't do. If you are in the business of what do you call it, I don't know, selling alcohol, then we don't do. You are in the business of whatever, then we don't do. And normally what we'll do is, if we have doubt, we will go back to our Sharia advisors to be able to advise us whether this is compliant. Because in the Sharia space, there is this thing called, let's say for example, if you are in the hotel business, if your revenue and profit is less than a certain percentage that comes from the selling of alcohol in the bar, then for whatever reason, the council define it as Sharia compliance. Yeah. So we don't what do you call it? We don't brand ourselves, neither we tag ourselves, or we don't label ourselves as Sharia compliant. But yes, we do Sharia compliant, and we do have Sharia advisor that advises, and we do produce Sharia-based product. For example, Sharia-based preference shares. You do that, and you can come and see us, if you are interested in doing that.
Okay. All right. I think so. We've come to the end of the session. It's already 12 p.m. right now. So, I mean, if you have any more questions that you have for Aimi, I think his email is there on the screen. And also there's an inquiry email to Atta Plus too. So if you have any questions related to Atta Plus or even to the topics that we've discussed today, feel free to contact them, right? So yeah, just to share with you, as I mentioned earlier, this is the number 2 of the Atta Plus education series. We have, I think, around 3 more in the future. So the next one will be on August 4th on preparing a pitch deck for you guys to pitch to investors. And I think on August 25th, we have a session on the secrets to an effective marketing campaign. So I think marketing campaign is crucial to the, I mean, any companies that want to be listed on ECF platform. So that Sasha will address that. So yeah, I guess that's the time that we have for today. Thank you very much, Aimi, for your time today, and thank you very much to Atta Plus for organizing this session and for sharing with us. So yep, I guess I'll see you guys in upcoming sessions, and take care and stay safe, guys. Bye bye.
Thank you.
What in the world am I gonna do tomorrow? Is there someone with a dollar I could borrow? Who can help me take away my sorrow? Maybe it's inside the bottle. Maybe it's inside the bottle. I had some good old buddies, names is whiskey and wine. Hey, hey. And for my good old buddies, I spend my last dime. Hey, hey. Now wine is good to me. You help me pass the time. And my good old buddy whiskey keep me warmer than sunshine. Hey, hey. Your mama may have blessed the child that's got his own. Hey, hey. If God has plans for me, I hope it ain't written in stone. Hey, hey. Because I've been working